Good evening, everyone. A very warm good evening to all of you. So let's wait few minutes and then we will start with our session. So guys, almost half of the class has joined now. Let's wait off a couple of more minutes. Let's wait so the rest of the people join as well. So we'll start in next couple of minutes. Yes, Ravi, you will have to raise a ticket about it and we can connect for your concern. Raise a ticket about it and let me know the time as well and we'll try to solve your concern. Yes, Ravi, correct. So yesterday we saw two theories. Can anyone name what were those two theories? The first theory was insurance theory, and the second theory regarding forward and spot prices was Hedging pressure hypothesis. Insurance theory said that market should always be in backwardation because the producers wants to hedge the risk and they will be selling in a future date at a discounted price, and the discount that they will be giving is the insurance premium that they usually pay. Hedging pressure hypothesis favors that the markets can be in backwardation or they can be in contango depending upon who is more eager to hedge the risk. The third theory that we are going to start our session with is theory of storage. And according to theory of storage, the formula for forward price is spot price plus storage cost minus convenience yield. Yes, Vaseem. So, according to theory of storage, the forward price is spot price plus storage cost minus convenience yield. Now, what does this mean? It means that let's suppose if the cotton price is at 12 rupees as of now, if the prices of cotton is 12 rupees as of today, derivatives are financial contracts. RT is asking, Ravi is asking, what is derivatives? Derivatives are financial contracts that derives its value from an underlying asset. So anything that derives its value from an asset, any contract, any financial contract that derives its value from some other asset is a derivatives. I'll come to what is convenience yield. For a moment, let's just ignore convenience yield and try to understand what the theory of storage try to say. Let's say convenience yield is zero. For example, ignoring convenience yield, what does theory of storage tries to say is this? Theory of storage try to say that if 12 rupees, yes, yes, the person who has connected from Dell PC, you're correct. This is the same batch. So the spot prices is 12 rupees. The storage cost is, let's say, that storage cost where you will be storing this is 2 rupees per kg. And for a moment, just assume that there is zero convenience yield for the product. So what is the forward price? So the forward price is 14 rupees. And where this 14 rupees is coming from? This 14 rupees is coming by adding the spot price and the amount that I have spent. I have not came to convenience yield, guys. Do you guys feel that I will just ignore convenience yield and move forward? For an example, we are assuming that over here convenience yield is zero. I'll introduce the convenience pro. I will introduce you to the concept of convenience yield in the next couple of minutes. Please let us get done with those things that we already know, like spot prices and storage cost. Then we will come to that thing that we don't know. Okay, so please hold on your thoughts for a while. So what is the forward price? It's 12 rupees, the price prevailing in the market as on today, plus 2 rupees as the storage cost. Because this is the rent that I am paying to store the commodity. So in future, I am expecting to pay you. I am expecting to get 14 rupees from you at a future date. Let's say 1 month from now. So everyone at least clear with this part of the formula. I have not came to convenience yield yet, and I am expecting no one knows what is convenience yield. So Apurva is not clear with the formula, and let me give an example to Apurva. Apurva, you and I are sitting in the to make a contract. You and I, Apurva, are sitting in a room to make a contract on cotton. You are the buyer of cotton and I am the seller of cotton. I am telling you that the market price for cotton is 12 rupees. And we are agreeing to sign a forward contract 1 month from now. 1 month later, you will be agreeing to buy the cotton from me at a predetermined price today. And I will be agreeing to sell the cotton to you 1 month from now at a price determined today itself. Now the question is, what should be the price that you are going to pay me after 1 month? That is the question. What should be the price that you are going to pay me after 1 month? So there was no agenda PM. Actually, PM is asking what is this theory is proving. So they are trying to prove nothing. They are just trying to justify that what may be the reasons of forward prices different from spot price. That is why we are learning these theories. What is the purpose to learn theories? Learn these theories is to understand why a particular commodity is being traded in backwardation or in contango. Why forward prices of a commodity is different from the spot price. HT, please mention your doubt in the chat box. What should be the price, Apurva, that you and I should agree today on which you will be buying the cotton and I will be selling the cotton 1 month from now? This is what we are determining, and that price is nothing but the forward price. But how will we come to forward price? How will we come to forward price? So while determining the forward price, what I will say to you, Apurva, 12 rupees is the price of the cotton and 2 rupees is what I will I will have to pay to the uh, I will have to pay to store this cotton for 1 month. So get this cotton from me, get this cotton from me at 14 rupees. Get this cotton from me at 14 rupees 1 month from now, because 12 rupees is the price of the cotton today and 2 rupees is the price of the cotton 1 month from now. Regarding notes, we will have a 5 minutes reserved at the last and there we will discuss about the notes. So don't worry. Please don't mention anything regarding the notes now. Please don't break the link of the class. Okay. Apurv, now are you clear? Apurv, now are you clear? This is what theory of storage says. Yes, I'll just give one more example for the calculation. Let's say, let's say that you have borrowed $1 million from the bank to invest in the market. You have borrowed $1 million from the bank to invest in stocks. And when it comes to stocks, you have invested in Reliance stocks. And for a second, assume that I and Diego, we cannot increase forward contract price, whatever may be the price, increase or decrease. So, Diego, you and I are going to enter into a forward contract you and I are going to enter into a forward contract where I will be selling this Reliance shares to you, selling these shares to you, and you will be buying these shares from me. So you are the buyer of the forward contract. You are taking the long position, and I am the seller of the forward contract. That is, I am taking the short position. Let's say that Reliance shares are currently trading in the market at rupees 2,900. And I have bought, let's say, 100 such shares. I have bought 100 such shares. So the total cost that is incurred to me to buy these shares as of now is 2.9 million, sorry, 0.29 million or 2,90,000. Now, the question is, Diago, my friend, at what price I am going to sell these shares to you 1 month from now? What should be the right price at which I and you should agree upon to buy and sell these shares? What should be the price on which we should make a deal that I will be selling the shares to you at that particular price, no matter what would be the prevailing price of the Reliance shares 1 month from now? So that price would be considered as forward price. Do you have any doubt till here, anyone? So you are saying just go for 5,80,000. No. So, so Arjun, what we have discussed is, sure, sure. Don't worry, I'm explaining it again. It's just that we are trying to make a forward contract on, we are trying to make a forward contract on Reliance as an underlying asset. I We are trying to make a forward contract on Reliance as an underlying asset. I have borrowed 1 million from bank. Out of that, 0.29 million is been invested in Reliance shares. I have borrowed 1 million from bank. I have invested in different asset classes, and out of that, 0.29 million is been invested in Reliance shares. Now, I am selling these shares. I am selling these shares 1 month from now at a price determined today, and someone will be buying it 1 month from now at a price determined today. So what shall be the price at which we should sign the contract on which the buyer will buy these shares and I am going to sell these shares? Everyone with me? Hema, please comment your question in the chat box. Please lower down your hand. Now, Diago says that sell these shares for to me. Diago says sell these shares to me for 2,800. Will I agree to him? Will I agree to him? Diago, will I agree to you? No. I will tell him that let's follow the theory of storage. Let's follow theory of storage and try to get to the forward price of the contract. Let's follow theory of storage and try to go to the forward, try to get the forward price of the contract. Now, according to theory of storage, let's say the amount that I have borrowed from the bank, I am paying the interest of 6% on it. I am paying the interest for 6% on it. So till the time I am going to hold these shares, worth rupees 2,90,000. Till the time I am going to hold these shares worth rupees 2,90,000, I am paying 6% on this 2,90,000 or 0.29 million. I am paying 6% interest on it. I am paying 6% interest on it. So if I want to store these shares in my demat account, 6% is the rent that I am paying. Can I say that 6% is the interest that I am paying? So can I say this 6% is my storage cost for these shares? Everyone with me? Can I say that 6% is the storage cost of these shares? Diego, are you with me? Yes, 6% is the yearly interest. So please give me the value 6% of 2,90,000. 6% of 2,90,000 would be 17,400. But this is what? This is annual interest. I want to convert into monthly. So 1450 is the interest that I paid. 1450 is the total interest that I paid on 100 shares. Now, what would be the interest that I paid for one single share? It would be 14.50 rupees. So can I say this 14.50 is the storage cost per month? Can I say this 14.50 is the storage cost per month? So according to theory of storage, it is spot price plus storage cost minus convenience yield. Let's ignore convenience yield for a second. Let's say convenience yield is 0. Can I say that the forward price that I and Diego will come to would be 2,900, that is prevailing price or the spot price, plus 14.50, that would give me 29, 14.50, 2,900 and 14.50. Can I say that? So this should be the forward price. This should be the price at which I and Diego should agree upon. Everyone with me? Everyone? Everyone with me? Now, let's say today is HT and DS. Please let me know what are your doubts in the chat box itself. Please lower down your hand and let me know what are your doubts in the chat box itself. Now, if you guys are with me, think about this. Let's say on 1st March, we agreed that 6% is used to determine the storage cost. We are going to pay that interest, and every seller is not going to bear the storage cost from their own pocket. They will take it from the buyer, right? So the person who is buying it, I'll charge this interest from him. I will collect that interest and pay it to the bank. So that is the idea, Ravi. On 1st March, we agreed, we signed the contract at 2,914.50 rupees. And the contract is going to mature on 31st March 2000 of the same year. So if it's 2024, this is 2024. Now, I have one question from you guys, that whether this 2,914.50 rupees will be paid by Diago, that is buyer of the contract, to me on 31st March, or whether it will be paid by the buyer to the seller on 1st March or 31st March. At what date is the buyer going to pay the amount of the forward price to the seller? On 1st March or on 31st March? On the date on which the contract is signed, or the date on which the contract is going to expire? When does the actual buying and selling is going to happen? When does the actual buying and selling is going to happen? The actual buying and selling is going to happen on 31st March. The actual buying and selling is going to happen on 31st March. So on 31st March, I will be giving him Reliance shares, and he will be giving me the money. Everyone with me? So let's ignore all those things. Let's just not unnecessarily make it complicated. This is just an example considering the Reliance shares. Generally, stocks are traded using futures and not forwards. So you asked me for an example, Ravi, and that is why I am trying to give you a brief example for this. Let's not jump into complexities for now. So on 31st March, the actual exchange is going to happen. He will be going to pay me the money. I will be going to transfer him the shares. Now the question is, my friends, whether whether in between whether in between Reliance pays a dividend. Whether in between if Reliance pays a dividend, who will get that dividend? Who will be the owner of that dividend? Whether I will be the owner of that dividend, or whether the buyer, that is Diago, will be the owner of the dividend. Perfect. So the person, let's say on 15th March, Reliance pays dividend. On 15th March, Reliance pays dividend. And on 15th March, since I am holding the shares, on 15th March, since I am holding the shares, I will be getting that dividend. I am the owner of that dividend. So when I and Diago is in conversation with each other, to determine the forward price, what I will say to Diago, spot price is 2,900. I am also paying interest for this. So I am incurring a storage cost to store these shares for the next 1 month. That is 14.80. Let's say Reliance is paying 10 rupees dividend. I was getting away with it. I was trying to finalize 2914.80. That is the forward price, and make Diago agree on this forward price. But Diago said one thing. Diago asked me one thing. Diago said that, sir, please sit back. Please sit back. I have heard, I have got a news that Reliance and all of these things are happening on 1st March before signing the contract. Okay. So I have heard the news that Reliance is going to pay dividend. Reliance is going to pay dividend worth 10 rupees each share. Reliance is going to pay the dividend worth 10 rupees each shares. Reliance is going to pay dividend worth rupees 10 rupees each share. And you are going to benefit from it. You are going to benefit from it since on 15th March, you will be holding those shares. So you will be saving 10 rupees on the cost of carry. You will be saving that 10 rupees on the cost of carry, that is holding the shares for the next 1 month. So I will deduct this 10 rupees from your price. I will deduct this 10 rupees from your price, and effectively I am going to pay you 2904.80, and that should be the right forward price according to theory of storage. And this should be the right forward price according to theory of storage. So on 31st March, I and Diego agreed to buy and sell these shares at 2904.80. Everyone with me? Now the 10 rupees that the benefit, how 80 and not 50? I don't know, GV, what you are asking. How 80 and not 50? Okay, sorry, 2915 point. Okay. So let's ignore this. Let's say this was just 00, 2914.00. So that was just a decimal error. Don't worry, ignore it. So are you getting the idea what I'm trying to say? Everyone? Everyone with me? Now, now the benefit that I receive for holding those shares, the benefit that I receive for holding those shares till 31st March is the convenience for me of holding these shares. Is the convenience for me for holding these shares, and that is convenience yield. Everyone with me? Convenience yield is what nothing but the benefit of holding the underlying asset. What is convenience yield? Benefit of holding the underlying asset. Holding the underlying asset comes with a cost as well as benefit, right? So you have incorporated the cost. Who will incorporate the benefit? So convenience yield incorporates that benefit. Correct. So this was about theory of storage. Now, yeah, in some cases, convenience yield can be zero where there is no benefit of holding that particular asset. If there is only cost involved and no benefit of holding that asset, then there won't be any convenience yield. The convenience yield would be zero. Now, who are the participants? Who are the participants that are that are going to who are the participants that are going to enter into a derivative contract? Yes, the forward price would be 2904.50. My dear friends, who are the participants? What are the type of participants who are going to enter into the derivative contract? So the participants are classified into three categories. If the dividend would have not been declared, the convenience yield would have been zero. Correct. Okay. So who are the type of participants? What are the type of participants? that would participate. Yes, yes, we will come to future as well, Wasim. Don't worry, we will come to future as well. Who are the type of participants who are going to enter into a forward contract or a derivative contract? So there are three types of participants: hedgers, speculators, and arbitrageurs. Hedgers, speculators, and arbitrageurs. These are the three type of participants. These are the three type of participants that are going to be participating and entering into a derivative contract. Now, what are hedgers? Hedgers are the one those who want to minimize their risk. The intention to enter into the derivative contract is to minimize the risk. Speculators are basically, you can say, traders predicting the market movements. Predicting the market movements. Hedgers, since they are minimizing the risk, they have an attitude that they hate risk. Speculators, on the other hand, loves risk. And why they love risk? Because they want to earn better returns. So higher the risk, higher the return. That is why in order to get better return, they love risk. They keep on taking more and more risk. Arbitrageurs are making riskless profit. Riskless profit. I'll give you an example of arbitrage in just a second. But arbitrageurs are emotionally risk neutral. They neither hate risk, neither love risk. They simply don't take risk. They can be either buyer or sellers. They can be either buyers or sellers. So it's not about that or hedgers are always buyers or hedgers are always sellers. Hedgers could be buyers and sellers. Speculators could be buyers or sellers. Even arbitrageurs do buying and selling both at the same time. So when we discussed about the participants, there are three types of participants: hedgers, speculators, and arbitrageurs. Hedgers are the one who intentionally enter into a contract with an objective to minimize their risk. So hedgers usually hate risk and that is why they want to minimize it. Everyone clear with hedgers? Speculators predict the price movement and based on that take trades. So they love risk in order to get highly rewarded from it. Arbitrageurs, on the other hand, are risk neutral. They neither hate risk, neither love risk because they don't take risk. Now you might be wondering that we saw an example of hedger where farmer was trying to hedge his prices, lock his prices so that he does not have to be exposed to risk of falling prices of cotton. Speculators are the one who trade on predicting the prices. So I am sitting on my desktop and I am predicting that today Reliance shares will hit a upper circuit. So I am taking a trade based on it. I am taking futures of Reliance and taking a trade based on it. Based on that, based on that, speculators try to speculate the market. It is very similar to betting, but if there is any information involved, you can classify speculators into two types. One who is betting on the stocks or predicting the stocks based on intuitions, or one who is making informed choices, so informed investors. Hedgers hate risk. I never said arbitrageurs hate risk. I said that arbitrageurs are risk neutral. They simply don't take any risk. They are not exposed to any risk. They are risk neutral. They have nothing to do whether the market will go up or go down. Hedgers, on the other hand, try to minimize their risk. They want to minimize their exposure of risk. Why are they there? They are there to make the riskless profit. Why are they there? They are simply there to make riskless profit. Speculators are also called liquidity providers because if everyone is hedging, if hedger is minimizing the risk, if hedger is minimizing the risk, someone has to take the risk, right? And who is going to take that risk? Speculator is going to take that risk. So are you getting how important each of these three participants are there in the market? Now, what is arbitrage? Arbitrageurs are one who do arbitrage. Now, what is arbitrage? Arbitrage is the process of making risk-less profit. Arbitrage is the process of making risk-less profit. So let's say the shares of Tata Motors are trading in NSE at 959 and at BSE the shares are trading at 957 rupees. Simultaneously, I will carry out a trade which would involve selling 1000 shares of Tata Motors and buying 1000 shares of Tata Motors from BSE. I will be selling 1000 shares of Tata Motors from NSE and I will be buying 1000 shares of Tata Motors from BSE at the same time. So here, since I am selling it, I will get 959,000. Since I am selling, I will get this payment. Since I am buying, I will have to make this payment. And I am ignoring the transaction cost. I am getting 2000 rupees as the profit. So without assuming any risk, considering that there was an arbitrage opportunity, I made 2000 rupees profit by simultaneously buying and selling. Now, if something is sold, whether the prices will go up or go down. If something is continuously sold by the market participants, whether the prices will go up or go down. So the prices in NSE will go down eventually. The prices in NSE will go down eventually, and prices in BSE, if something is bought, let's see, we have not determined the last class. It depends that how the things goes on. It could be today itself, it could be in the next class. If something is bought, Shivam, tell me, if you are selling, if the stocks are being sold by everyone in the market, will the prices go up or go down? NSE is National Stock Exchange, BSE is Bombay Stock Exchange. If everyone is buying the stock, the prices will go up or go down. So prices will fall from 959 to 958 in NSE, and prices in BSE will go up from 957 to 958. This is just an example. And at last, the prices in NSE will be equal to prices of BSE. And at that point of time, arbitrage, correct. So here the prices would go up, here the prices would go down, and it would converge to 958. And here the arbitrage opportunity will get exhausted. Here the arbitrage opportunity will get exhausted. Yes, we can do that. We can do that. GB. So, Shivam, please bear with me. I am explaining this again. There are two stock exchanges. Consider these stock exchanges as two villages. Consider these two stock exchanges as two villages. Or forget about this example. Let me go to the different example where you will be able to understand it in a better way. There is village A and then there is village B. You are a, it depends wherever you are getting a better price, buy it from there itself. Where, while buying wherever you are getting a lower price, buy it from there. While selling wherever you are getting a higher price, sell it over. So GS, Shivam, be there with me. There is village A and village B. The prices of coffee in village A is 18 rupees and prices of coffee in village B is 16 rupees. Actually, the trader makes 2 rupees, right? 2000 rupees, 1000 shares. So 2 rupees per share is what the trader makes. They are buying for 959. They are actually buying for 957 and selling for 959. So the difference is what the profit is being made by the arbitrager. Consider this GS. Are you there? GS, please be attentive. Please be interactive in the chat box as well. I'll ask you a few questions in between to let me know whether you are understanding it or not. Perfect. So the price of coffee is 18 rupees in village A. Price of coffee is 16 rupees in village B. Let's suppose you bought 100 kg of coffee from village A and 100 kg you sold at village B. What is the profit that you made? What is the profit that you made? You made 200 rupees profit because you have bought at 16 rupees, sold at 18 rupees, 200 rupees is the profit that you made. Now, how this is an arbitrage? Simply because you made a phone call and decided that I will be buying coffee at 16 rupees, and with the another phone call at the same time, you decided that you will be selling this coffee for 18 rupees to village A. From village B, you bought the coffee. From village A, you sold the coffee. Yeah, that could be one of the examples, GB, but I'm not aware about that example, so I won't comment on it. But you are correct. This is how our arbitrage works. Now, why this is an arbitrage and why this is not a trade? Because here the investor or the trader, or let's say the arbitrager, did not assume any risk. If he would have bought this today and sold it tomorrow, this won't have been an arbitrage. Why? Because who knows whether the coffee will remain at 18 rupees till tomorrow or not. It could be that tomorrow the price would change to 17 rupees. It could be that tomorrow the price will change to 14 rupees. So he is taking the risk over here. But in case of an arbitrage, that all the two, both the trades are carried out at the same time. So simultaneously he bought at 16 rupees and at the same time he sold it for 18 rupees, making 2 rupees profit. That is an arbitrage for you guys. This is what arbitrage is. Are you clear with this, Shivam? Soumya, even you? Are you clear with this? Prachi, you're not clear with this? Okay. Simply, guys, Cost price 16 rupees. I am explaining, everyone. Please be there. Please be there. Guys, please be there. I am explaining again. Not on the same day, at the same moment. Even not on the same day, but at the same moment. Cost price is 16 rupees. Selling price is 18 rupees. Cost price is 16 rupees. Selling price is the 18 rupees. What is profit? You bought something for 16 rupees, sold it at 18 rupees. What is the profit? 2 rupees is the profit. Now, what is an arbitrage? Making this 2 rupees without taking any risk. Without any risk, making this 2 rupees is an arbitrage. Everyone clear what is arbitrage? Let me come to how can this arbitrage be made. This 2 rupees profit shall be made without taking any risk. That is an arbitrage. So how that arbitrage can be made? I will buy this at 16 rupees from one person and sell it at 18 rupees to the other person at the same time. At the same time. You will be buying this from one person at 16 rupees and selling this to the other person at 18 rupees at the same time. Here you are not taking any risk. What is the risk? Risk of things not getting sold. Things of list of risk of things not getting sold. This is one risk. Other risk is things of price changing. You have locked in the selling price. You have locked in the cost price. So without taking any risk, you are making 2 rupees profit, and this is sure shot profit for you. That is arbitrage. Everyone with me? Everyone understood this? PJ, did you understood this? Arbitrage these days could only be done into future and options, as carry forward is T+1 and we cannot sell it back if we have yet not received it. If these days we take the gap advantage of NSE and BSA with regards to the future prices. So it's not generally possible. RK, I'll come to that as well. RK, so there is something called as cash and carry arbitrage. So you can enter into a future contract and you can also enter into a spot price. So you will buy it at the spot market, sell it in the future market, and there you can generate an arbitrage opportunity. Yes, it also happens in the share market. So you can sell a future and buy a spot of the particular. You can sell in the future market, buy in the spot market, and then there you can create a arbitrage opportunity. So this was about the market participants. Yet I have not came to futures, so I won't be giving high level remarks on futures. So let me just complete futures and then we will take doubts regarding futures as well. So without investment, technically, it is not your own money, GA, but you are actually investing. You can't make profit without investment, right? You are investing margin. That is the case. So if there would have been, it would have been without investment, everyone would have made the profit, but you need investment for it. Now, technically, yes, theoretically, you are correct that arbitrage assumes making profit without investment. So 18 rupees, you have sold coffees. 16 rupees, you have bought coffees. So you will get the payment 1800 from your customer, and you will be giving 1600 to your supplier, and you will be making 200 rupees profit. Where is your own money involved in this? You don't need to involve your own money in this, right? So theoretically, yes, arbitrager, our example supports that arbitrager needs, arbitragers generally make money from without investing anything, but that is theoretically possible, but practically you need to invest a margin. I hope you are getting this. Okay, perfect. Shivam, tell me, do you still have any doubt? And if yes, what doubt do you have? Please let me know the point where you're not clear, Shivam. And if you are clear, allow us to move forward. Sir, except arbitrage, which business on same day? I'm not getting Shivam what you're trying to ask. Sir, except arbitrage, which business on same day? Not on the same day, but on the same moment you are taking two simultaneous trade, that is buying and selling. That is what arbitrage is. It is not about being on the same day. Yes, GA, that is the example of cash and carry arbitrage. And I will come to it. I will come to it. Just allow me some time and you will be pretty much clear with that as well. Yes, yes, I will be discovering that in the future class. I'll get to that in the future class. Don't worry. Swapnil, what doubt do you have? Please comment your doubt in the chat box. Don't raise hands. Now, okay. Now, we discussed forward contracts. If anyone asked you to highlight the characteristics of forward contracts, can we do that? What would be the characteristic of a forward contract? First, it would be customized. It is an over-the-counter derivative. It could be customized, it means that it could be negotiated. It is an over-the-counter derivative. It means that you will have to find the buyer of the forward contract yourself. The buyer has to find the seller of the contract themselves. Correct. It is not regulated. There is no rules and regulations applied to it. Although there are legal technicalities to it, if you have signed a contract, you will have to obey that, but still. Fourth, counterparty default risk. It means that let's say I have agreed to sell the cotton at 12 rupees 1 month from now. And 1 month from now, the price of cotton in the market is 18 rupees. And I sell all my cottons in the market. I sell all my cottons at the market price to some other buyer. What will the buyer do? What will the buyer of the forward contract or one who is taking the long position in the forward contract would do? He will find the case against me. The case will go on. But these forward contracts comes with a counterparty default risk. It means that the prices that are fixed, the promises that are made can be broken, and promises are meant to be broken. Right? Everyone with me? Everyone with me? To mitigate this so that no counterparty, neither the buyer. So SK, let's suppose you and me agreed to a price that you will be selling me cotton for 12 rupees after 1 month. And after 1 month, the price of cotton is 18 rupees. Yes, forward contract do exist. So After 1 month, the price of the cotton in the market is 18 rupees and you don't sell the cotton to me at 12 rupees, you sell it at the market of for 18 rupees. What can I do to you? I could do nothing. I could file a case, but that is unnecessarily a hassle for me. So that is why there is a chance that the counterparties, I can default for you, you can default for me. So the counterparties of the forward contract can default for one another. That is counterparty default risk. Over the counter derivatives, it means that these are negotiated and customized. It means that we will be sitting on a table and deciding the terms and condition of the contract. I and you, based on a mutual discussion, be deciding the terms and condition of the contract. There is no legal document or structured deal or a fact sheet which says that this should be terms and conditions that should be followed by you and me. So over the counter derivatives means we will be sitting over the table and based on that, we will be making up a deal. And someone asked whether whether forward contract still exists or not. Tell me, guys, what is advance payment received from the customers? Advance payment received. Yes, I'll come to over the counter once again. Don't worry. What is advance payment? It is one of the type of the forward contract where you are agreeing to sell a particular product on a future date at the price logged in today. Now, what is over the counter derivatives? Basically, derivatives are of two types when it comes to the involvement of people. So there is OTC derivative, over the counter derivative, and then there is exchange traded derivatives. There are exchange traded contracts. And then there is over the counter contracts. Now, what is over the counter contracts? In over the counter contracts, the farmer will have to search himself. Yes, but that was just an example, GA. So it is very similar to agreeing on the advance payment received or else advance booking made. If payment might not have been received, advance booking is also made, right? That I agree to buy these things at a particular price from you without paying anything. So that could be the example of forward contracts. So farmer over here, in case of a forward contract or the over the counter contract, will have to search for the counterparty himself. What the farmer will have to do? He will have to search for the counterparty himself. Like he will search for the businesses that wish to buy cotton. So this is over the counter derivative. These farmer and businessmen will sit on a table and determine the clauses, will sit over the counter to each other, will sit in front of each other and decide the clauses of the contract, determine T and C, that is terms and conditions of the contract. While exchange traded contracts are standardized, if I am selling future, so one of the example of exchange traded contracts are future contracts. So if I am selling futures, I don't know who is buying. If someone else is selling futures and I am buying, I don't know who I have bought from. So the counterparty don't know each other and they don't really have to know each other because an exchange is involved in between. A stock exchange is involved in between who will make sure that none of the party defaults. A counterparty will be involved in between who will make sure that none of the party defaults. Neither the buyer defaults nor the seller defaults. So are you clear what is over the counter contracts? Here, the things are made with negotiation and customization. Here, things are standardized. Here, rules are same for everyone. And it is a highly regulated market. Yes, you can say that there is something called as gray market. There you can buy shares. You can contact some brokers and buy shares before IPO is being listed. And that could be an example of over-the-counter market. So guys, we will be starting. Yes, these requires initial deposits and margin. I'll come to that. We will be starting with future contracts. So the one who asked me about OTC derivative, PM, are you clear with this, Pragati? Are you clear with this? OTC derivative and stock exchange traded contracts. Perfect. Perfect. The next is, so advance payment received or a promise made to buy a particular product on a future date. Yes, yes, we will take a break. We will take a break. Let me just name this. Is an example of forward contract. So advance payment received where you are agreeing to sell something at a future date, or bookings made where you are promising to buy something at a future date. These are the example. These could be taken as an considered as an example of forward contract. Coming to future contracts, we will be discussing future contracts in 5 minutes. Next 5 minutes. Go on a break. Be right back from the break, and then we will be starting fresh with the future contracts. After futures, we have options, and then we have swaps. So be back right on time, guys. Let's try to finish it up options till today so that we can move on to the next module. So go on a break, guys, but be right back on time. I don't know, Wasim. Let's see. Let's see what happens. Yes, KG, I'll request the team to do that. I'll request the team to upload those notes on your behalf. So technical team is on a holiday on Saturdays and Sundays. That is why it has been not uploaded. It would be uploaded by Monday. Don't worry about it. Don't worry, the topics that would be covered in the class would be sufficient enough to build up a good knowledge base. So I won't suggest any external books. Although you can do your own research and go for any other book that you wish to. Yes, KG, the PDFs would be uploaded on LMS tomorrow. The technical team is on holiday on Saturdays and Sundays, so it would be uploaded by Monday. Don't worry. Yes, Ravi, don't worry about it. We will be having sessions on financial modeling where you will get a really good practical exposure of these subjects. Yes, it is technically possible. It happens, but it is available for a very short period of time, and that is why the opportunity exists for very short period. Nevertheless, institutional brokerage houses uh, get the good benefit out of it. So there are some arbitrage funds. They try to look into arbitrage opportunities, although you need a very good infrastructure to execute these funds. A common person like you and me cannot invest that heavily in such an infrastructure, and that is why it won't be possible for a retail investor to make that investment. But still, KG, which notes are you not available with? Please raise a ticket about it. Please raise a ticket about those notes that you are not available. So those who are not able to see the notes in LMS, please raise a ticket about it. The ticket will be forwarded to a respective team, and you will be available with the notes. So some of you who are not able to see the notes, please raise a ticket about it. The technical team will get in touch with you, and we will get the reason why the notes are not visible to you. So Arjun is asking what is invisible hand theory. We saw automatic stabilizers, right? So invisible hand theory is nothing but another word for automatic stabilizer, which says that if every person is like working on the economy, there is an invisible hand which will take economy to automatically stabilize. So there is no need of any other intervention from the government or any political party or even the central bank to interfere in the economy. If every person is working in the economy, eventually sooner or later, things will automatically stabilize. This is what invisible hands theory says. It's the definition goes, if I remember, something goes like this: that there is always an invisible hand which is working to make things normal. So it goes something like this. I don't remember the exact definition, but it is same as automatic stabilizer, just a different word for it. I got it, RT. You won't be disappointed. Don't worry. So those who are not getting it, please raise a ticket about it. Those who are not getting the notes, please raise the ticket about it. So futures contract. So futures contract. So those who feel like any suggestions to be made up regarding LMS, mention that in the ticket. The ticket will be forwarded to the technical team. Okay, let's get back to futures contract. So futures contract are nothing but exchange traded forward contracts. Future contracts are nothing but exchange traded forward contracts. Future contracts are what? Future contracts are nothing but exchange traded forward contracts. What was the new need of future contract when there was a forward contract? Forward contract had counterparty default risk, and future contract mitigates the chances of counterparty default risk. For a financial system to well function, it is essential to establish a platform where the default is as less as possible, and future contracts helps the economy in doing so. So earlier, farmer was directly entering into a contract with businessmen. Businessmen trusted farmer and entered into the contract, but it could have been the possibilities that one of these people might have been breaking the promise. But over here, the farmer would not make deal directly with the businessman. What they would do, there would be an exchange, stock exchange. Farmer will be selling those contracts of cotton in the stock exchange, and stock exchange will make sure that farmer the stock exchange will make sure that the farmer sets true to its promise. Mitigates means eliminate. Eliminate. Mitigate is just a different word for eliminate. Stock exchange will make sure that farmer. So where was I? Just give me a second, guys. Sure. Stock exchange will make sure that farmer does not break his promise. On the other hand, businessmen will also enter into a contract buying it from the stock exchange. So on the other hand, stock exchange will also need to make sure that none of the parties, including the businessman, also does not sets back from the words that they have committed. Now, how is this made? Before coming to it, how future contract actually functions, we have to see few terminologies. Please be there with me. It is going to be very interesting. There is something called as types of settlement. One is physical settlement. Other one is cash settlement. One is physical settlement and the other one is cash settlement. In physical settlement, at maturity, commodity will be transferred physically from one place to another. In a physical settlement, the commodity will be transferred physically from one place to another. So if farmer has promised to sell the cotton, farmer will be transferring cotton from his place to the location agreed upon while signing the contract. That is physical settlement. Everyone clear with the physical settlement? Everyone? Okay. Now cash settlement. Let's say the price agreed was 12 rupees and price in the market now is 18 rupees. So what will happen? Instead of transferring the cotton, instead of transferring the cotton, again, it is customized contract. So Khushbu is asking who will bear the transport cost in physical settlement. It is a customized contract. Let's say K, that I and you agree to sit upon and sign a forward contract. We will have to finalize this through negotiations that who is going to fund the transportation cost. So I and you will be we would be agreeing upon a mutual clause that would say that either you or me are going to fund the transport clause. The third thing can be we can split the clause, right? We can split the cost as well. So that is depend on the customization. In the cash settlement, the physical transfer is not made, but just the difference is settled by the cash. Difference is settled by cash. But customization is made in forward contracts. Yes, that is correct. Types of settlement is different from future contract. Types of settlement is altogether a different heading from future contract. I said that in order to make you understand how future contract actually function, we need to see these theories that what is type of settlement, what are the two different types of settlement. Now, how forward and future contracts? So seller does physical and buyer does cash settlement. No, that is not the case. Sure, I'll explain that again, don't worry. But remember that physical settlement, okay, I'll come to that, but let us just be clear with physical settlement and cash settlement. Sure. I'll trying to explain it. Just wait a second. You will be pretty much clear with it in the next few minutes. Price agreed to sell. So today's price is 12 rupees. Price agreed to sell after 1 month, that is forward price after 1 month is 16 rupees. The actual price after 1 month, that is spot price after 1 month, in scenario A is AS1 is 20 rupees, and in scenario B is 12 rupees. Everyone with me? Are you getting what this denotation means? This is spot price, forward price, spot price. This is at time 0, spot price at time 1. And this is example 1. No. So I am talking, let's say that contract is signed at 1st March and on 31st March is the expiry. And we are analyzing that how the settlement will be made on expiry. With me, everyone? PM, are you there with me? So this is the evaluation on 31st March. Spot price with time 2. And this would be my example 2. So I agreed. Let's say I am a seller. I agreed to sell. What happens in physical settlement? I agree to sell the commodity. I will transfer that commodity to the buyer. Physical transfer will happen to the buyer. We are doing that on 31st March. We are analyzing that on 31st March. So Physical transfer of the commodity is happening on 31st March. No matter whatever may be the price, it doesn't matter what is the price in scenario 1 or scenario 2. The client will pay me 16 rupees for it. And I have to transfer this to the client's location. Everyone clear with the physical settlement? No doubt. No doubt in physical settlement. Everyone clear? PM, are you clear? Pragati, are you clear with this? Shivam, are you clear with this? If not, please mention it in the chat box. So their buyer, it's not about the buyer doing physical settlement or seller doing physical settlement. It's about the underlying asset. It's about the underlying asset, PM. Whether the underlying asset is been physically given to the buyer or whether the cash is settled in terms of the underlying asset. That is the question over here. It's not about buyer making the physical settlement or seller making the physical settlement. The settlement is in terms of underlying asset. If it is a physical settlement, it would be the physical transfer of goods. In a physical settlement, guys, the goods, cotton, let's say cotton is the underlying good. Cotton will be transferred from one place to another. That is physical settlement. Yes, PM. It could be either physical or cash. It won't be both. Everyone with me? The good or the product that is tangible asset would be physically transferred from one place to another. Everyone with me? Seller will take this cotton from over here. Seller will take this cotton over here and transfer this cotton from this place to this place physically. That is physical settlement. On the other hand, what happens in case of a cash settlement? The cotton will remain to farmer itself. The cotton will remain to farmer itself. The cotton won't be physically transferred. The cotton won't be physically transferred. Let's say in scenario A, 20 rupees is the price of cotton. 20 rupees is the price of cotton. And the price that was agreed was 16 rupees. So farmer won 4 rupees. Farmer won 4 rupees. Everyone with me? Farmer won 4 rupees because he agreed to sell it at 16 rupees. And the current price is 20 rupees. So this 4 rupees will be given to the farmer. This 4 rupees will be given to the farmer. Okay. If in scenario 2, the price becomes 12 rupees and he promised to sell it for 16 rupees. In this case, farmer will have to give this 4 rupees to the businessman. So that is a loss of 4 rupees for the farmer. So that is cash settlement. The cash will be transferred because Prachi is asking why. Because the price was fixed at 16 rupees. The price was fixed at 16 rupees PJ. If price becomes 20 rupees, Just a second, guys. I think there is some confusion. I'll just come back on it again. Just give me a second. There is a farmer. Then there is a businessman. The price is 20 rupees. If farmer would have taken this to businessman, he would have got something worth. What if the prices, we have to make payment according to the contract, right? Yes, that is true. So effectively, it will work according to the contract, and you will see how. If so, guys, there was a confusion. Please be back. Forget about what was discussed last time. If the price is 20 rupees in the market, as per the scenario one, farmer is going to pay the businessman 4 rupees. Question is why? Because what was the price locked at? The price was locked at 16 rupees, right? The price was locked at 16 rupees. Businessman bought this for 20 rupees, and out of that 20 rupees, 4 rupees has been funded by the farmer. So effectively, what is the price to businessman? Effectively, what is the price to businessman, Prachi? 16 rupees. Effectively, if businessman has bought it, so Priyanka, everyone, if you guys are still confused, don't worry. Let me just explain this again. I am saying that if price is 20 rupees, PJ is saying prices are fixed. Yes, prices are fixed, but for the forward contract, right? This is forward price. Forward price is fixed. Is market price fixed? Can two people control the market? No. Market price is not fixed. Forward price is fixed. Yes, we are making contracts to avoid the price volatility, and you will see how the price volatility will be eliminated. If the price is 20 rupees, if the price is 20 rupees, farmer will be providing 4 rupees to the businessman. There with me? If the price is 20 rupees, farmer will be providing 4 rupees to the businessman. Why? Why? Because what was the price locked at? 16 rupees, correct? Businessman bought the commodity at 20 rupees from the market price, but the farmers promised to give it for 16 rupees. So out of this 20 rupees, 4 rupees will be funded by the farmer. So effective cost to the businessman is 16 rupees. Clear with this, everyone? Still no? No worries. No worries. So there are two people who are not clear with this. Priyanka and Prachi, hold on your thought for a while. Why farmer will fund? Even Kriti, Shivam, these guys are not clear with this. No goods will be transferred. Correct. In this case, no goods will be transferred. If farmer need to refund 4 rupees, why buyer is paying 4 rupees? Businessman is the one paying, right? Okay, okay. Let's say this is a farmer located in Kashmir. I am coming to that why farmer will pay 4 rupees. This is a businessman. Let's. This is a farmer located in US. This is a businessman located in India. Don't confuse yourself. Let's say consider that both are the contract is made in rupees. Don't think about the currency terms. Try to understand forward contracts over here about the cash settlement and physical settlement. the price, that is the forward price, was fixed at 16 rupees. He will be selling at 16. He will be buying at 16. Any doubt still here? Those who said that they are not getting it. Any doubt still here? Now, now, let's say the price in the market is both in US and India. Don't bring storage theory over here. Think this in completely different perspective. Unnecessarily, you will get confused. Don't think in terms of storage theory and all. Don't think about the transportation cost. Don't think about the convenience. Please try to be there with me. What I'm trying to explain. Please try to understand the whole picture. Market price is 20 rupees. He wanted to buy it at 16. He wanted to sell it at 16. Correct? Correct? Market price is 20 rupees. He will be selling in market of Kashmir. He will be selling in market of Kashmir for 20 rupees. He will be selling in market of Kashmir for 20 rupees. What is the profit made by him? He could have sold it for 16 rupees, but he is selling it for 20 rupees. He made a 4 rupees profit. But he does not own this 4 rupees profit. Why? Because he promised to sell it at 16 rupees, right? He promised to buy it at 16 rupees, but he will have to buy it at 20 rupees. He made this 4 rupees loss. But does he deserve to make this loss? Because he had already fixed the price, right? Does he deserve to make this loss? No. Does he deserve to make this loss? Everyone, he fixed the price at 16 rupees to buy. He fixed the price at 16 rupees to sell. He didn't deserve to make the loss. He didn't deserve to make the profit. He will transfer this profit to him. He will transfer this 4 rupees profit to him. It means that 20 rupees at which the businessman has bought the cotton, out of that 4 rupees will be funded by the farmer, and the rest 16 rupees is ultimately the price that was fixed. So that this profit was just a hypothetical profit. Farmer can sell it directly to the businessman at what price was fixed. Yeah, he could have done that, but that is in case of if the clause was physical settlement, then he could have done that. If whatever you mentioned, you are stating just opposite of it. Contracts. What is the benefit of the contracts? The buyer based on the promise. Am I right, sir? Yes. Why the farmer needs to get to the market? Simply because cotton is available in US as well. Cotton is available in India as well. Storage cost and transportation cost. Let's say storage cost for cotton is 0. He is keeping it at home. Yes, everything is mentioned in the contract. True. Let's say that things that have been, both of them has been settled. This is a negotiated contract, and the things that have been settled is like There is no storage cost. He is keeping the cotton at his home. So market price is not going to matter. Definitely, this is what is happening. Let's say if market price is 16 rupees or 12 rupees, still he is getting 16 rupees for the cotton. Still he is paying 16 rupees for the cotton. Because this is cash settled. This is settled in cash. There is no physical settlement made. So Prachi is saying there are few comments by Prachi. Let's read that out. What is the benefit of the contract? Everything is mentioned in the contract: storage cost or transportation cost. Why there is a fuss? So market price should not matter. Why are we even considering or discussing that the price in the market is 20 rupees? Selling price includes transport cost. Everything includes in this selling price. Everything is included, even the convenience of everything is included in this price, in this selling price. That is what I am saying, that this loss, this profit is hypothetical profit, this loss is hypothetical loss, and this would be settled. Everyone, please try to understand what farmer wanted in exchange of cotton. Just give me a second, guys. NB is saying then the seller wouldn't be able to get profit due to market price. To the mic and speak, your voice has dropped. You are making it complicated. I am not making it complicated. You are being reluctant about it to digest that the things can be settled cash as settled in cash as well. You are thinking this farmer and this businessman, you are thinking the world revolves around them. That is not the case. This farmer can sell the goods to anyone. This businessman could buy the goods from anyone. And you guys are reluctantly thinking that this farmer should sell the goods to this businessman and the businessman should buy the good from this particular farmer. That is what you guys are thinking. You guys are in businessman is the one making profit in future. Farmer has nothing to do with it. There is a contract between them. Correct. There is a contract between them. But does that contract, what is the contract? Contract is means that the farmer will be selling cotton for rupees 16. That is the contract. The businessman will be buying cotton for 16. That is the contract. The farmer should get the cotton for 16 rupees. Businessman should buy the cotton for 16 rupees. That is the contract. It shouldn't matter whether the farmer is selling to this businessman or any businessman in the world. In case of cash settlement, does it matter, PJ, that when you are buying Reliance shares, does it matter you have bought that shares from which participant, which particular person? Do you get the information who has sold the shares to you? No, right? Similarly, the contract is made where farmer should be getting 16 rupees for the cotton and businessmen should be getting cotton for 16 rupees. That is what the contract is made. There shouldn't be any discussion about with to whom this cotton is actually being sold, or whether the cotton is being sold or not. That is also not the case. I am not the farmer. Still, I am person A and he is person B. Let's say PJ, I and you entered into a contract. There is me and then there is PJ who has entered into a contract. I am giving him forward contract. I am taking a short position on forward contract. PJ is taking a long position on the forward contract. Yes, guys, they are obliged to buy and sell. Oh my God. So guys, basically you are thinking from a very narrow perspective. You are thinking that they are obliged. No, no, we have not came to MTM transaction, guys. PJ, please raise a ticket about it. We will connect one to one. And even Priyanka, you guys raise a ticket about it as well. Those who are not getting this, please let me know. How many of you are not getting this? How many of you are not getting this? Oh my God. Okay, Kriti is not getting this. Khushbu is not getting this. Okay. Shivangi is not getting this. Shivangi is not properly getting this. And PJ and Priyanka is definitely not getting this. Even Envy is not getting this. Hold on for a second, Ravi. Hold on for a second. Don't worry. Forget everything. Forget everything. This is going to be very interesting. Yes, yes, I am explaining again. Any of you guys, I will explain everything. Please lower down your hands. Please lower down your hands. No, this would be the best example to make you understand. Any one of you has had any doubt about physical settlement? Any one of you had any doubt about physical settlement? That is clear. Perfect. Every one of you are clear with physical settlement. If any one of you want me to repeat physical settlement, let me know. It's not about being profitable or not. Businessman is not profitable. Any of the cases, neither the farmer nor the businessman is profitable. Perfect. Now, physical settlement is disappeared. Physical settlement has disappeared. Everyone with me, pay 100% of your attention. Physical, guys, please don't comment anything. Please try to listen. Please try to be interactive with me. Don't, please, guys, please, give me a second. There are few people. Actually, I am thinking like farmer is intended to value his promise and is respecting his contract done with the buyer and seller. So in this case, the farmer and buyer are going on possible track, which is best for both. Am I right? No, you are not right. Example of Amazon, they charge convenience yield. Example of Amazon, they charges convenience cost. It is up to customer whether we want to buy it. So buyer pay the price. That is me. Perfect. Consider now that you have forgot everything. We will be starting right from scratch about cash settlement. We will be starting everything right from scratch. Please don't allow any of the other thoughts to come into your mind. Not Amazon, nor Flipkart, nor Mintra, nor farmer, nor businessman, anything else. Please don't think about it. Please be there with me. And if you won't be able to still get it, I will connect with 100 of people one to one and I'll try to explain it. So, physical settlement, all of you guys were clear with physical settlement. And I am saying, I am saying that physical settlement is out of picture. Physical settlement is out of picture. The contract will be settled in cash. The contract will be settled in cash only. So that what is the type of settlement? The type of settlement is cash settlement. Let's say, let's say that there is me. I am not a farmer. I don't own any cotton. I don't own any cotton. And then there is PJ. Actually, you guys would unnecessarily be confused. Let's be back. Let's be back with the farmer example because it's essential for you to distinguish between cash settlement and physical settlement. There is one farmer, that is farmer and businessman. Okay. Cash settlement means no physical settlement. No physical settlement. So if there is no physical settlement, PJ, if there is cash settlement and there is no physical settlement, will there be any transportation of goods? Everyone with me, please interact. If there is no physical settlement, will there be any transportation of goods from one place to another? So will there be any transportation cost? Perfect. There won't be any transportation cost. Farmer forward price is 16 rupees. Farmer should effectively get 16 rupees. Farmer should get 16 rupees for the cotton. For selling it. Businessman should get 16 rupees for the cotton. Should pay 16 rupees for the cotton. For buying it. Everyone with me? It won't mean whether farmer will get it from businessman or not. We have not came till here. The I want to earn 100 rupees. Whether I want to earn it from the farmer, from businessman one, from Ramji, Shamji, Damji, how does it matter? How does it matter that if I want to earn 100 rupees, I can earn it from anyone, right? How does it matter? How does it matter? I have bought Reliance shares from someone named Iran or someone named USA. It won't matter. It would never matter. Please think on these terms, guys. Please think this in a mature way. Now, we have entered into a contract. So Prachi, yes, I agree that we are into a contract. And how this contract will be settled, and this is a cash settlement. How will this happen? You will get to know that. You will get to know that. Just give me a second. So futures contract are settled in cash. That is the idea over here. Think about this. Let's Prachi said that if there is an exchange, it doesn't matter. Okay. Can I say that when I was giving the example of the market, it will sell, he will sell in the market. Where is that market? That market is nothing but the exchange. Okay. So if there is an exchange, it doesn't matter. That is what Prachi you are coming to. So there is an exchange. Correct, Prachi. Which I am saying, I am not getting irritated actually, but it's nothing. completely normal. Don't worry about it. So few of you are, I think there might be some communication back gap just because we are not able to. There is not a two-way communication possible over here. I'm not getting irritated. I'm sorry if I'm sounding harsh or rude, but I'm not getting irritated. I'm perfectly fine. Mm. So what is happening is you guys, yes, this is a very simple concept and it is taking too much time. So don't worry, guys, be there with me. We will be done with this in the next 5 minutes. Now, farmer wants to get 16 rupees for it for selling it. Buyer wants to buy it at 16 rupees and he will pay 16 rupees for it. Till now, the scenario is clear with everyone. Till now, the scenario is clear with everyone. Perfect. Let's say the price after 1 month, that is at maturity, becomes 22 rupees or 20 rupees or 12 rupees. Let's say 22 rupees. If 22 rupees is the price, farmer will sell farmer will sell this cotton in the market for at the rate of, if farmer is selling the cotton in the market, at what price he will sell it? What is the extra money that farmer is having? I won't call that profit. I think the profit was the word that you got confused with. I won't call that word profit. What is the extra money that farmer is having? Farmer is having 6 rupees extra. Very good. Everyone clear? But did the farmer deserve this 6 rupees? Everyone with me, PJ, especially you. Did the farmer deserve this 6 rupees? No. Perfect. Perfect. Let's leave farmer here. Let's come to the businessman. He will be buying, he will be buying cotton from the market. He will be buying cotton from the market. He will be buying cotton from the market. At what price he will be buying it? 22 rupees. What is the extra amount that he paid? He paid 6 rupees extra. But he wanted 16 rupees for it. Does he deserve to pay this 6 rupees extra? Does he deserves to pay this 6 rupees extra? The answer is no. So this 6 rupees extra that he didn't deserve to make, he transferred it to him. That is settled in cash. That is settled in cash. That is settled in cash. Because this is cash settlement, he does not need to physically transfer the good. PJ is asking why. PJ, let's say you gave an Amazon example. Let's say, forget everything. PJ, just please be there with me for 1 second. Let's say, PJ, tomorrow is your birthday. Okay. And I ask you, PJ, as a friend, what gift do you need from me? You said that I need iPhone 16. Yes, that 6 rupees has been transferred to the business. Yes, yes, AR, I am getting that. But I'll talk to only PJ because she's very reluctant to believe that how can they have entered into a contract, and how can that stupid farmer and that stupid businessman can buy it from the market. That is what PJ is telling us, that if they have if they have entered into a contract, why they are moving out of the contract. Actually, they are not moving out of the contract, PJ. Think in these terms, that tomorrow is your birthday, and I asked you what gift do you need. You said I need iPhone 16. So how would it matter? An iPhone 16 cost, let's say, 1.5 lakh rupees. Then how would that matter if I am transferring you 1.5 lakh or I am transferring you iPhone 16? The intention is the worth of amount should be delivered to you, right? I will transfer you 1.5 lakh and you will get an iPhone 16 for it. It is same like me getting the iPhone 16 and getting it to you. Are you getting this, PJ? And everyone? Again, someone else is also there. Just a second, guys. It is going to be very interesting. So RK is saying, here we are talking about business ethics, about reimbursing that additional 6 rupees, about reimbursing that additional 6 rupees which he had incurred. But does this happen in real time? Yes, obviously this will happen in real time because this is an exchange. This is a regulated market. You guys are thinking like we are selling this on a retail shop, that you guys are thinking I will share this I will sell this future contract and I will not make the payment. That is not going to happen. That is a regulated market. And that is why cash settlement is made in regulated market. We should definitely not think about physical year. That is what I am saying from first. So from here, when I was saying market, you guys were very reluctant to understand that if two parties are entered into a contract, how can these parties sell it to someone else and how can he buy it from someone else? You guys were very reluctant to digest the fact that the world does not revolve around, the world does not exhaust in between these two parties. The idea over here is to get the same benefit in monetary terms. These are financial contracts, guys. Don't think emotionally. Don't think emotionally. Yes, market is open for all, and these are financial contracts. You are thinking, you are studying finances with emotion. How is this possible, guys? Please try to understand. PJ and anyone, any doubts regarding this? Any doubts regarding this? Regarding cash settlement? Yes. The motive is to be very clear. If I am selling, I want 16 rupees for it. If I am buying, I'll buy it at 16 rupees. Perfect. Yes. One doubt, sir, can buy from any seller. How can market exchange will know that so and so businessman has buys the cotton from so and so seller? Oh my God. And how the market exchange is identifying, Ravi, you're, you have a really genuine doubt. And I am really glad for your curiosity. Ravi is asking that how will the exchange know that which seller have you bought from? Because here the buyer is selling to the exchange, the seller, the buyer is buying from the exchange, and seller is selling to the exchange. So exchange is a mediator between buyer and seller. That is why the exchange would know. But GV, it was essential to have a diversifying factor and distinguish between forward and future. And commodities are something that is also cash, that is also traded. So based on that, it was essential for us to understand this. So that was all. Okay, so with this, we were done with the characteristics of futures. The final characteristic of future is the final characteristic for future is it is marked to market. Now this is a different Ramayana, but try to understand it. I'll try to make you understand this. A person A has entered into a future contract with person B to sell Reliance. He is the seller. So guys, just wait for a couple of minutes. We will be done with mark to market and we will be done with futures. Only topic we will be remain with is options and swaps that will be covering in the next class. Yes, GB, you are correct. So A is the seller, B is the buyer. Reliance shares, let's say 10,000 Reliance shares are being traded. He will sell it on a future date on 31st March. And he is going to buy it at 31st March. That is the contract that has been made. The price, the forward price is 2,900. 1 month later, the price and the spot price is also, let's say, 2,900. So 1 month later, they have agreed. They have agreed. He has agreed to sell the Reliance shares at 2,900. He has agreed to buy it at 2,900. Everyone with me till here? When I asked you in case of forward, when will the buyer pay to the seller? What did you guys say? When, at which date the buyer will be paying to the seller? You guys said 31st March, correct? But in case of futures, the settlement are made between them every day. The settlement are made between them, between the parties every day. So if prices will go up, the buyer of the contract benefits. If prices will go down, the seller of the contract benefits. And that is the reason why exchange requires investors or traders to invest or deposit margins. What are margins? So let's suppose I have bought these 10,000 shares of Reliance. So exchange will ask me, Mukund, you pay 2,90,000 rupees to me. Just a hypothetical example. That is the buyer. And exchange will ask the seller to pay 2,90,000 as well. Everyone, please be there with me. Last couple of minutes, guys, you are definitely going to enjoy this. Let's say in the first day, I made 30,000 profit. Let's say I made 30,000 profit in the first day. So my total margin will become 3,20,000. And the seller's margin will become 2,60,000. On the next day, let's say I made 50,000 loss. So my margin will become 2,40,000 and seller's margin will become 3,10,000. Since I am making the loss, he will be making the profit. Let's say on the fourth day, seller made a loss of 1 lakh and I made a profit of 1 lakh. So the new margin available to me would be 3,40,000. So this is the process of mark to market, that is being settlement is made, calculations are made at the end of each day. that is why that is why forward contract comes with default risk, whereas future contract, since the margins are taken initially, future contract does not has default risk. The counterparty default risk does not exist in case of futures contract wise, because margin is collected by the exchange. Because the margin is collected by exchange. Okay. Has everyone got this? Has everyone got this, SK? Please wait. I'll explain this to you. But those who have got this, that was all it for the day, guys. Those who have got this, that was all it for the day. You can leave. Yes, one thing more, PJ. Yes, tell me. Yes, I will share the sheet. When will buyer get the shares? Again, these are cash settled, PJ. These are settled in cash. So why would buyer get the shares? It just buyer would pay the cash for it, right? So that effectively the buyer or the seller may be able to sell it or buy it at the effective rate. This is a cash settlement. So iPhone 15, I will pay you for it. I can't. Shares are virtual. So yeah, shares are not transferred actually. Instead, the cash is paid to buy those shares. Hypothetical. You mean the word hypothetical? Correct, PJ. So thank you, guys. Those who are done with this can leave. Those who are feeling that we are being late, it's perfectly fine. You can leave if you have understood. Both buyer and seller has to pay every day. Not every day. Once you have deposited the margin, if you are earning profit, your margin is safely available, right? So you don't need to pay every day. But the calculation will be made every day. The calculation will be made every day. Margins are collected by whom? By the exchange. Margins are collected by the exchange in the future, in case of futures contract. KG, I already told you, please raise a ticket about it. Your issue will be resolved. Yes, P&L is shown every day. Correct. So basically, guys, basically think over here. Buyer has agreed to buy the shares, seller has agreed to sell the shares. If prices increase, buyer will benefit. If prices fall, seller will benefit. The concept is clear till here. Who will benefit on what? Everyone. Okay. So if prices increase, buyer will benefit. If prices fall, sellers are going to benefit. Now, let's suppose if buyer prices rise. If I am the buyer and prices are been rising, I made 50,000 profit. If I have earned 50,000, someone might have been lost 50,000. And who is the one who has lost that 50,000? The seller has lost that 50,000. Correct? Seller is incurring a loss since I am incurring a profit. Everyone with me till here? Everyone? Perfect. Now, if think for just one single second, think that if this would have been forward contract, would the seller would have given me 50,000, or he could have straight away ran away from the contract? If this would have been the forward contract, he would have not stand to its promise and he would have ran away from the contract. To eliminate this risk of the forward contract, what future contract do? What actually exchanges do in a future contract? What is future contract? Just an exchange traded forward contract. So what exchanges do? They will collect margins from me. Yes, margin is the new word for you. Consider deposits. They will collect deposit from me, and they will collect deposit from the seller as well. They will collect deposit from buyer, and they are going to collect deposit from seller as well. If buyer, for example, makes profit, at the end of the day, he will get his deposit plus profit. And if seller is making a loss, he will get deposit minus loss by EOD, correct? And if, let's say, buyer is making a loss, he will get deposit minus loss back. And if seller is making a profit, if buyer is making a loss, seller will be making a profit. So he will get deposit plus profit. That is mark to market. This calculation is made every day. Now you might be thinking, let's suppose deposit of 3 lakhs has been made. And for 10 consecutive days, each day seller keeps on losing. Each day seller keeps on losing and buyer is making the profit. So the total margin available with the buyer at the end is 6 lakh. That is, all these 3 lakhs available to the seller is being transferred to the buyer, and buyer has made the profit. So what exchange will do? Exchange will ask, if you want to be in the contract, add more money, add more margin. If you don't want to be in the contract, exit from the contract and the contract will be closed. So this was about marked MTM process, mark to market process in future contract. Understood, everyone? Yes, your view are correct, PJ. How to enter the contract? We enter the contract by buying it. We square off the contract by selling it. If you have sold the contract, you will have to square off the contract by buying it. So you need to take the opposite position for entering and exiting the contract. So yes, all the margins buyer will take to his home if he has ultimately made the profit in the contract. So that was all, guys. It was really exciting to see your curiosity and your 360-degree view of analyzing things. Have a great week ahead, guys. Yes, the class has ended. We have concluded our session. You can buy the future contract or forward contract from the stock exchange. You can search tomorrow when the market will be open, search for Reliance futures, and you can buy those contracts based on your discount broker app. I use Grow, so I will search on Grow. You can use on Upstocks or any of the company that you want. So bye-bye, guys. Have fun. Thank you. Thanks a lot for listening so patiently. Sorry if there would have been any confusion. Thanks a lot. You guys have been a wonderful audience and I really enjoyed the session. MS, you have raised the hand. Please let me know if you have any queries in the chat box, or else let's end the meet for all. Yes, I am going to teach Excel. Exams will be conducted once you are done with the curriculum. Once you are done with the full curriculum, then the exams will be conducted. So bye bye guys. Take care. Have fun. Enjoy your day.